How long will the bear market last?
How long will the bear market last? Okay. This actually came up in one of our client strategy sessions. So we found some information, and this is something I've talked about actually over the this year, especially as the markets come down. Some of the history and what happens, and it's really kind of interesting. So let's take a look at this. I've got a little chart here. There we go. All right. So this is from MarketWatch. It was from an article where they did some research looking back, and World War II, so 1946 to now. And this is a little out of date only because we actually have just had a bear market, and I'll point that out in a minute. But we have a 5 to 10% drop 84 times since the end of World War II. So if you think about it, I think it's about 76 years since the end of World War II. Mm-hmm. So more than once a year. Mm-hmm. So pretty common. Recovery time average is 1 month. All right, not bad. Still, go through lots of those. We had a lot of those last year, at least close to them. 10 to 20%, which is what we had for most of this year up until this week. There's 29 of those. So, what's that? About every 3 years, give or take. 4-month recovery, not bad, right? The next one's pretty rare. That's where we are now, 20 to 40%. And we're just very at the top of that, 22%. And there's now 10, including this one. Yep. And the recovery time is 14 months. So just to answer the question, in a brief sense, the average recovery time in a bear market, which would be more than 20%, is 14 months. And so, we have a ways to go to kind of get out of this as far as that goes. And then the very rare downturns, the really big ones, 40% or more, there's only been 3 of those, 1973, 2000, 2008. And that has a 58-month recovery. Oof. Yeah, so again, that's good information, but for me, one thing I focus on the most in my portfolio development is that big downturn. Mm-hmm. I believe that we should try to ride through pretty much everything else, mm-hmm. and have the right stock and bond mixture, maybe move some little target pieces once in a while to try to take advantage of trends that you see happening, rebalancing, mm-hmm. those types of things. But the problem with these big downturns is that they're so long for recovery. Mm-hmm. Again, if I'm 75 and I'm living off of my retirement assets, that 58-month recovery is going to be brutal. Yeah. And we've been through it. I've got clients, they've survived through 2008, that type of thing. But that's why I'm really watching these recession indicators, mm-hmm. Because all of those had a recession attached to them, combined with, some pretty serious market downturn, mm-hmm. Motion. And so that's the thing I'm looking at right now. Are we in this just kind of standard bear market with a 14-month recovery? Then you kind of want to, rebalance and just kind of take advantage of that, because 14 months isn't that long. Mm-hmm. It's going to seem longer, believe me. But are we going into this bigger downturn, this 40% plus type of thing? Are we going to add a number to that? Is that going to be a 4 instead of a 3? And the one thing is that although the economy is starting to slow down because of what the Federal Reserve is doing, it's still pretty hot. Mm-hmm. And so theoretically, the Fed could push the brake, on the economy, hopefully bring inflation down to a certain point, and not kick us into recession, right? But the market's worrying about that right now, let me tell you. And there's a big battle of debate going on as to what might happen here. But that's important to kind of understand the stats of the market, in my opinion.
Yeah, where do you put the pandemic kind of downturn? Because that was such a quick downturn, but the recovery was also so quick.
Yeah, well, it fits in that. There was 20 to 40%, because it was down 35%. Mm-hmm. And so it was one of those 9. And the recovery was faster than 14 months, but 14 months is the average. So you're going to have, some at 20 and some at 10, whatever it might be. And the pandemic was kind of unique because it created a response from the government that was so dramatic. Mm-hmm. And that's what we're paying the price for that now, right? I mean, the amount of money that came out in stimulus from the Congress, the Federal Reserve, the Treasury, I mean, it was unprecedented. We'd probably be talking about Great Depression if they hadn't have done it, in my
Yeah.
opinion. And so there's a lot of people worrying about what's happening right now. If we could run a parallel universe where they didn't do all of that stimulus, you would be talking about something else. Because we got up to, what, 15 million unemployed people
Yeah.
overnight. We're down to, what, 5 now, give or take. So we've reabsorbed, people back into the workforce at a pretty good clip. There's, 2 jobs open for every one person looking. I mean, it's a pretty strong scenario altogether. But there is a price to pay for that too, and that's what we're paying now. So pandemic fits into that, last one. This one's different because this is more of a potential financial issue. Depends on what the Federal Reserve does, and so there's so much emphasis placed on looking at what the Federal Reserve is saying. And I tell you what, this last meeting, I thought they said some things that didn't make sense to me, really for the first time. And also, one of the problems for the Federal Reserve, in my opinion, is over the last 12 months, the market has been saying, hey, here's how much rates are going to increase. Here's what's going to happen. Here's what's going to slow down. The market's been much more accurate as a whole than the Fed. Because from their reports, they were saying X, Y, and Z. The market's saying, nope, it's going to be worse than that, or higher rate increases, or whatever it might have been. The market's been right, and the Fed's been wrong. So the Fed's continually trying to catch up. And of course, what you have 7 or 8 essentially economists, public servants, so to speak, running the Federal Reserve, one of the more important portions of our economy. But the market is made up of this just ginormous, money machine, and lots of money is being placed into trying to see where things are going. And maybe the market's a little bit better at it than the Fed. So we'll see. But anyway, that's a good question. 14 months is the answer, but we really hope we don't get to that 58-month one. I don't want to add a number to that 3. Let's keep it at 3. Be my preference, but gotta be aware. All right.